Okay, so I've decided that I'm gonna cut the short sell videos. I think obviously I wanted the short sell videos to be there to show you kind of how residual this income can be, even if it's just small income, and it can have a huge impact on you. But a lot of the people that are going to be watching, they might not choose exactly the 30, positions or the 30 investments that I have. I think you should have a fixed number of investments. I think it should be balanced, and I'll go over this here in a second. But the reality of it is everybody's going to kind of pick and choose their own investments. I'm going to really kind of move now the majority of my focus to kind of outlining the core principles and just continuing to outline core principles that can lead to a greater financial stability. That's what we need. Greater financial stability. We're not going to get to greater financial stability by looking for home runs or by looking for rainbows or by looking for lottery tickets or by luck. Financial stability is built over time, step by step, precept upon precept, line upon line, good principle upon good principle. This is how you get to financial stability. And it just takes time. And sometimes it can feel like a grind. It can it can feel too long, but life's extremely long. And the balancing act between trying to get where you're going tomorrow and getting there as soon as today, that's where we've got to really find that balancing act to establish like patience. We've got to be able to kind of breathe through this and to make sure that we are not looking for immediate outcomes, right? What we can see along the way though is that we're hitting milestones and mile markers and making improvements and getting there. But if you forget about those principles, even long after, right? Say you go through the grind and you get into those principles and you find yourself sitting in Westlake, Texas or whatever in some boss house, you forget the principles. You forget the idea that it's built line upon line, precept upon precept, and that it's also maintained line upon line, precept upon precept. You can outstrip whatever you're earning. Some of the poorest people I know make the most money. They just spend more than they make. It doesn't truly matter if you can't budget, if you can't manage it, and you can't invest it appropriately. Whatever you build can be lost. So this isn't just for people who are trying to build it. It's for people who are trying to keep what they've built. But the idea of it is it's step by step, slowly but surely. From an investment standpoint, I did a lot of videos on the short selling. I wanted you to see how impactful little short trades can be in your overall investment strategy and platform. Those principles, they don't go away. We'll continue to highlight them once a month when we do recaps. I'll continue to highlight the short positions that I have. And then when I see something dip 2%, I buy it, and then I set the sell price for 2% up. And then I enjoy the benefit of the wiggles while my long position, right, is just riding the whole wave and getting really the kind of overall overarching benefit. My short positions are all about optimizing those point in times, those emotional moments. And I'm going to stop posting about those short sales. Once a month, I'll give a recap of it. We'll talk about the principles again, but really I want to focus on more of the overarching theory. So I'm going to show again the 5 principles of investing. And that's the focus here. We want to go over the 5 principles of investing. I've already done a video. Please feel free to refer back to it. But I just want to give a visualization of this so that as we kind of step outside of the daily updates on the short trading and start getting into other things like budgets, buying homes, establishing good credit scores, things of the nature, all the million variables that come into play to help and increase your financial health. As I really start to focus on those principles, every month we'll recap the idea of investing, we'll recap the idea of the short trading and so forth. But here is the focus on the 5 principles of investing. Let me throw this up so that we can just recap it very briefly. And then later this week, I'm actually going to move on to buying homes and home buying. But 5 keys to investing, right? Number 1, again, pick the right platform. Information is key, data is king. As your investment grows, really optimizing or really understanding and managing your taxes as well as reinvestment decisions becomes as important as the initial investment itself. It's very important that you have a platform that gives you the information you need to make the decisions that you want. Then it's about Goldilocks volume. It's about having enough positions in your investment portfolio, enough companies, right, that you can put your eggs in multiple baskets, but not too many and then you're just chasing every whim and wham. Like you should know the companies that you invest in. You should believe in what they do. You should feel strongly about their long-term benefit, because the majority of our money we are going to make over the long term, not on the short term. So we're not buying into the emotion of the market. We're really looking at the weight of the market, the P&Ls, the strength of those companies and what they can do over the long term. But want to pick the right number of companies. Again, spread yourself across multiple baskets, but not too many baskets that you lose the impact of one company or another, or that you just start chasing anything and everything that's available. Number 3, find balance. I love half dividend stocks, half growth stocks. Just whatever your number is. I love the number of 30 stocks. I own 30 positions in the market. Half of them are growth stocks, half of them are dividend stocks. I love to have that kind of a balance, risk and reward, turtle and hare, and kind of manage that accordingly. And then number 4 is stay in your lane. Once you've picked your stocks, those are your stocks. If you believe them enough to put them in your portfolio, then something has to really force your hand to pull them out. Don't go above 30 once you've picked 30. And if you like something and you want to pull it in, you have to assess and know that you like it more than one of your existing 30s. That's for your long positions and short positions. You just don't go outside of your 30. I mean, the S&P operates like this, and you'll hear news every once in a while. Remember last year, Tesla got notification that they were going to get pulled into the S&P. It was big for them. Their stock's up, I think, 60 to 70%. Within like a month of that announcement. But for them to get pulled in, somebody had to get pulled out. And they always kind of announce that. They pull in and they pull out, but they stay with that fixed number. This is what you want to do. Stay with a fixed number. If you want to pull something in, got to pull something out. And then just invest in that. Stay in your lane. Don't go chasing cars. You're going to get run over. And then last, the 5th, the big growth is always going to come from long-term investment. You should really and truly put the majority of your money into long-term investing and keep it there. And if you want to put all your money into long-term investing, by all means. However, pulling a small percentage of your money to look for those emotional kind of moments in the market, to take advantage of those emotional markets, I found to be very fruitful. Last month, 37 short positions were sold. I get 2% on each. It's a fantastic way to make some additional income, or to kind of build the value of money that then you can reposition into long-term positions. So if you want to do some short-term positions, just do a small percentage of your money, and then make sure your short-term positions are within your TE30, your 30 companies that you've chosen. Don't go outside of that. Stay in your lane and allow that big growth to come over time, and then optimize any short-term growth. But if you're going to do short investments, keep them within your existing investment portfolio. Just put a little bit of extra money aside and put that into the kind of emotional moments on your 30 stocks. Those are the 5 keys to investing: right platform, right volume. I like 30. I call it the TE30. My name's Tim Edwards. That's the TE30. Feel free to name it after you. It's your mutual fund. Pick a number, right? Find the right balance: dividend stocks, growth stocks. Then stay in your lane, right? The idea is those are the stocks that you have. Those are the stocks that you invest in. If you've got money to put into it, put it into those 30. If you want something new into there, you got to like it enough to pull it out. And then number 5, right? The majority of your money should be in long-term, calm, chill out, just let it grow over time, type of investments. If you want to put all your money there, by all means. If you do want to do some short trading, do it with a small percentage of your money. I would suggest 25%. Do it with a small amount of your money, and only take short positions in your mutual fund, in your TE30. Don't go outside of it. If you're going to put money into anything, put it into those 30 companies. That's the ones you believe in. Those are the 5 keys to investing. I will go over investing later, where we're going to break down and kind of do like a investing 101 as well as a investing 202, talking about when you pull up a stock and all the information that you can see on that, from 52-week highs and lows, and and your deltas and your EPSs and all of that around. We're going to go through that. I'll have a whole video in a class on understanding how to pick your TE30. For right now, these are the 5 keys to investing. We won't be doing daily shorts videos any longer, but I will recap it on a monthly basis for anybody who does want to do short positioning to really emphasize or re-emphasize the principle and the benefit that can come from that. Joey Knish builds a fat stack over time, little by little. It's from investing well, it's from budgeting well, it's from having good credit scores, it's from buying the right kind of houses, and anything and everything in between. We're going to talk about how to do and build a good financial health for yourself and for your family. And we're going to cover it from a multitude of good principles because each and every one of them impacts the overall health of your finances, right? As the tide rises, all boats rise. If you have anything negative out of any one of those elements, it will eventually create a negativity to all of those elements. It is very encompassing, the idea and the ability to get financial health. So let's do it together and let's get this thing going.